Let us now solve the ISC 2018 Class 12th Economics paper. I am Surbhi Arora and I will help you in solving this paper. Taking the first part of first question, which is define deficit financing. So deficit financing is a budgetary situation when the government expenditure is greater than the revenue which the government is getting, and it is made up of the difference by borrowing or uniting new funds. So the government expenditure, when it exceeds the government revenue, the difference is deficit and it is financed by making new funds available. Our next question is differentiate between current account and capital account of balance of payment. Under current account, it records the export and import of goods and services as well as unilateral transfers. Unilateral transfer means one-sided transfers. Under capital account, it records transactions of purchase and sale of foreign assets and liabilities. Under current account, it has a direct influence on the level of income of the country. Under capital account, it does not have a direct influence on the level of the income of a country. Under current account, it includes all items of a flow nature, so it is a flow concept. Under capital account, it includes all items expressing changes in stock, hence it is a stock concept. What is meant by price discrimination in monopoly market? A monopolist may charge different prices for his product from different sets of consumers at the same time, and this is known as price discrimination in monopoly market. Define utility. How is marginal utility derived from total utility? Utility is the sum total of marginal utilities which is derived from the consumption of different units of a commodity. That is, TU, total utility at n number of units, is equal to unit 1 plus unit 2 plus till the unit n. And marginal utility is the net addition which is made to the total utility by the consumption of an additional unit. Therefore, marginal utility at n is equal to total utility at n minus total utility n minus 1. Explain the overdraft facility given by banks. An overdraft allows the individual to continue withdrawing money even if the account has no funds in it or not enough to cover the withdrawal. Basically, overdraft means that the bank allows customers to borrow a set of amount of money. Considering the second case where supply is perfectly inelastic and demand increases, we again take price on y-axis and quantity demanded and supplied on the x-axis. And SS is the supply curve and D, D1 are the demand curves. When demand increases, the demand curve shifts to the right from DD to D1, D1. Supply curve SS is a horizontal straight line parallel to the x-axis. Due to increase in demand for the product, the new equilibrium is established at E1. Equilibrium quantity rises from OQ to OQ1, but equilibrium price remains the same as OP since supply is perfectly elastic. With the help of diagrams, show how equilibrium price and quantity of a commodity are affected when demand is perfectly inelastic and supply decreases. We look at this graph which is here. On the y-axis we show the price, on x-axis we show the quantity in units. And DD is the demand curve which is perfectly inelastic, and S and S1 are the supply curves. When the supply increases, the supply curve shifts to the right from SS to S1, S1. DD is the vertical straight line which is parallel to the y-axis. Due to increase in supply, the new equilibrium is established at point E1. Equilibrium price falls from OP to OP1, but the equilibrium quantity remains the same as OQ since demand is perfectly inelastic. Explain two differences between factor income and transfer income. Factor income refers to the income which is received by factors of production for rendering factor services in the production process. Transfer income refers to the income received without rendering any productive sendi in return. Under factor income is included in both national income and domestic income, whereas transfer income is neither included in national income nor in the domestic income. Explain the meaning of full employment and involuntary unemployment. Full employment is a situation in which all those people who are willing to work at the prevailing wage rate are given employment. Involuntary unemployment means a situation in which people are able to work and willing to work at the existing rate of wages, but they do not get the work. Why is price per unit equal to AR and MR under perfect competition? Under perfect competition, the AR, that is the average revenue or the price, remains fixed. Therefore, MR, which is marginal revenue, will always be constant. Define implicit cost and how is it different from explicit cost? Implicit cost refers to the cost of self-supplied factors or the factors owned and employed by the firm itself. For example, the salary of an entrepreneur. Whereas explicit cost is the revenue incurred for outside payment or hired factors. Differentiate between contraction of demand and decrease in demand. When the quantity demanded falls due to increase in the price, keeping other factors constant, it is known as contraction in demand. When the demand falls due to an unfavorable change in the other factors at the same price, it is known as decrease in demand. Under contraction in demand, there is an upward movement along the same demand curve. And in case of decrease in demand, there is a leftward shift in the demand curve. If we see the curve, the reason under contraction of demand is because of the change in price, the quantity demanded changes. But in case of decrease in demand, other factors may influence the demand except the price. So the demand curve shifts towards the right. The supply curve of labor is an exception to the law of supply. Justify the statement using the diagram. In case of labor supply, the law of supply is not applicable in the normal way. If the wage rate rises, after a certain level, labor supply may fall in order to have more leisure time. The supply curve in such a situation is backward bending. We take the wage rate on x-axis and the labor supply on the y-axis. We see a backward bending supply curve, which is LS. Now, WC is the critical wage rate where L1 is the total labor supply. However, when the wage rate starts rising above WC, the supply of labor gets reduced. At W1, the wage rate, the labor supply will fall from L1 to LO. This is because after giving a considerable amount of labor, individual labor will prefer leisure at a very high wage rate. A consumer consumes goods X and Y. Given below is his marginal utility schedule for goods X and Y. Suppose the price of X is ₹2 and of Y is ₹1 and the income is at level 12. Now we have to state the equi-marginal utility and explain how the consumer will attain equilibrium. Now we take the units from 1 to 6 in column 1. We equate the marginal utility of x with the price of x and the marginal utility of y with the price of y. So in the table at unit 1 we have 8 as the marginal utility equated with the price of x, and for y it is 11, and so on and so forth. The consumer will be in equilibrium when he is buying 1 unit of x and 4 units of y, and he will be spending his rupee 12. At this level, he maximizes his utility as the marginal utility of the last rupee spent on each of these two goods is the same, that is 8 utils. Explain any two factors affecting price elasticity of demand. The two factors are nature of commodities and existence of substitutes. Under nature of commodities, in case the commodity is a necessary item, the demand for necessary items is less elastic. Without these commodities, we cannot think of our existence. Whatever may be the price, demand for necessities will remain stable. In case of comforts, price elasticity is unitary elastic or equiproportionate change in price and demand. In case of luxuries, the demand for luxuries is relatively more elastic. In case of existence of substitutes, the greater ease with which substitute can be found for a commodity, the greater will be the price elasticity of demand and vice versa. Derive a market supply curve from two hypothetical individual supply schedules. A market supply schedule is expressed as the supply of A commodity, B commodity, C commodity, and so on. And SM is the market supply curve, and SA and SB are the individual supply of supplier A and supplier B, and so on. Now let us understand the derivation of market supply schedule with the help of the table. Assuming that there are only two producers, that is A and B in the market. On the first column we take the price in rupees and individual supply units SA and SB in the next two columns. We add these two supply and we get the market supply in terms of units. So as seen in the table, market supply is obtained by adding the supplies of A and B at different prices. If more variable factors are employed to fix factors, the total product increases initially at increasing rate and finally it decreases. Explain this law with the help of a diagram. This phenomena is explained by the law of variable proportions, which states that as we increase the quantity of only one input, keeping other inputs fixed, total product, that is TP, increases initially at an increasing rate, then at a decreasing rate, and finally at a negative rate. In the diagram which follows, the quantity of the variable factor has been measured on x-axis and y-axis measures the total product on y-axis. The diagram indicates how the total product and marginal product changes as a result of increase in the quantity of one factor to a fixed quantity of other factors. This law can be better explained through three stages. The first stage is the stage of increasing return to a factor. In the first stage, every additional variable factor adds more and more to the total output. It means total product increases at an increasing rate and marginal product of each variable factor rises. Better utilization of fixed factor and increases in the efficiency of the variable factor due to specialization are the major factors responsible for increasing returns. The increasing returns to a factor stage have been shown in the next diagram. Between O to P, it implies TP, total product, increases at an increasing rate till point P, and MP, which is marginal product, rises till it reaches its maximum at point K, which marks the end of the first phase. Explain how a firm in perfect competition incurs losses in the short run equilibrium. In the short run equilibrium, let us explain this with the help of the diagram. In the figure, on the x-axis, we take the price. On the x-axis is the quantity. We see that a firm can incur loss in the short run when price is lower than the short run average cost curve but greater than the average variable cost. So ABC is the average variable cost curve, SAC is the short run average cost curve, and SMC is the short run marginal cost curve. The equilibrium point is at E2 and P2 is the equilibrium price and Q2 is the equilibrium output. The total revenue is equal to OP2 and E2 P2. So this shows the total revenue, and the total cost is OABDQ. So the total cost is higher than the revenue. Therefore, the loss is at AB, E2 and P2. So that area reflects the loss. Thus, whenever average variable cost is less than the price and price is less than the short run average cost, the firm incurs losses. Now, strategy of the firm is to minimize its loss. If the firm closes down, its loss is equal to the total fixed cost, which is A, B, C and D. Explain any 4 features of perfect competition. The features of perfect competition are homogeneous product. Homogeneous product is a product which is identical in size, color, packing, etc. Due to this, all firms become price taker in the market. Entry and exit. Under perfect competition, a firm can freely enter or leave any industry. There are no legal restrictions on entry or exit of firms. Accordingly, whenever there are supernormal profits, some new firms will enter the industry, and in case of losses, some existing firms will leave the industry in the long run. A large number of buyers are there in case of perfect competition, so that no individual firm or producer or seller or individual buyer can influence the price of a commodity. Each buyer makes transactions in this market at a prevailing price. A large number of sellers. Under perfect competition, the number of firms selling a particular commodity is so large that any increase or decrease in supply by an individual seller fails to impact the price of the commodity in the market. The individual seller can sell whatever amount it wishes to sell at the existing price of a commodity. All sellers in this market are price takers only. Explain the concept of maximum price legislation with the help of a diagram. The maximum price legislation or the price ceiling refers to fixing the maximum price of a commodity at a level lower than the equilibrium price. The ceiling is normally imposed on goods of mass consumption like wheat, rice, sugar, etc. In the diagram, demand curve DD and supply curve SS of wheat intersect each other at point E, and as a result, OP equilibrium price is determined and OQ is the equilibrium quantity. Now suppose the equilibrium price OP is very high and many poor people are unable to afford wheat at this price. As wheat is an essential commodity, the government interferes and fixes the maximum price known as price ceiling at OP1, which is less than the equilibrium price of OP. At this control price OP1, the quantities demanded OQD exceeds the quantity supplied OQS by OS and QD. This is the case of excess demand. Excess demand may lead to black marketing or hoarding in the market. Explain the shapes of total fixed cost curve and the average fixed cost curve. Give one reason each to justify the shape of the two curves. The total fixed costs are those costs which remain unchanged with the change in the level of output. These costs are incurred even when the output is zero. In the diagram, the fixed cost is taken on y-axis and the output on the x-axis. The output may go from 0 to 5, but the fixed cost remains the same at level 20. So whatever be the output, the total fixed cost remains the same and is parallel to the x-axis. The average fixed cost refers to the the per unit fixed cost of production. It is calculated by total fixed cost divided by the quantity or the number of units. In the diagram, we show the cost on y-axis and output on the x-axis. The average fixed cost keeps coming down. It's similar to the demand curve, which comes downwards towards the right. Now AFC falls with the rise in output because the constant TFC is divided by the increasing output. AFC curve is a rectangle hyperbola, that is, an area under the AFC curve remains the same at different points. A point worth noting here is that AFC keeps coming down to x-axis, but it will never touch the x-axis because average of anything cannot be 0. If more variable factors are employed to fix factors, the total product increases initially at increasing rate and finally it decreases. Now comes the third stage, which is known as the negative returns to a factor. In the third stage, the employment of additional variable factor causes total product to decline. Marginal product also becomes negative. Therefore, this stage is known as negative returns to a factor. Poor coordination between variable and fixed factor is the basic cause for this stage. In the figure, the third stage starts after point N on MP curve and point M on the TP curve. Marginal product of each variable factor is negative in the third stage. So, no firm would deliberately choose to operate in this stage. If you see this diagram, the TP and MP are shown on the y-axis and units of the variable factor on x-axis. The number of units are denoted from 1 to 6. At point P, till point P, total product rises at an increasing rate, and beyond point P till point M, it increases at diminishing rate. And after the point M, the total product starts to fall. The marginal product reaches the maximum at the end of the first stage itself at point K, and it increases and then it starts to decrease. And at the point where total product is maximum, the marginal product at that point is 0. And when total product starts to fall, the marginal product becomes negative. Now in the second stage, which we also call it as the diminishing returns to a factor, every additional variable factor adds a lesser and lesser amount of output. It means total product increases at a diminishing rate and marginal product falls with an increase in the variable factor. The breaking of the optimum combination of a fixed and variable factor is the major factor responsible for diminishing return. The second stage ends at point N when MP is 0 and TP is maximum, that is at point M. The second stage is very crucial as a rational producer will always aim to produce in this phase because total product is maximum and marginal product of each variable factor is positive. Discuss how prices of related goods affect the demand for a commodity. Related goods can be of two kinds: substitute goods and complementary goods. A change in the price of substitute directly affects the demand for a given commodity. When the price of substitute goods rises, demand for the given commodity also rises. An increase or decrease in the price of complementary goods inversely affects the demand for the given commodity. Explain how a producer attains equilibrium using total revenue and total cost approach. A firm attains the stage of equilibrium when it maximizes its profit. That is, when it maximizes the difference between total revenue and total cost. After reaching such a position, there will be no incentive for the producer to increase or decrease the output, and the producer will be said to be in equilibrium. According to total revenue total cost approach, the producer's equilibrium refers to a stage of that output level at which the difference between total revenue and total cost is positively maximized and total profits fall as more units of output are produced. Therefore, two essential conditions for producer's equilibrium are: the difference between total revenue and total cost is positively maximized, and the total profits fall after that level of output. When the price remains the same at all output levels, like in case of perfect competition, each producer aims to produce that level of output at which he can earn maximum profits, when the difference between total revenue and total cost is the maximum. Explain how a producer attains equilibrium using total revenue and total cost approach. Let us understand this with the help of a table where a market price is fixed at 10 rupees per unit. If you look at the table, the first column represents the output in units, the second column the price which is constant at rupees 10, the total revenue which is the output into the price, and the total cost which is there, which reflects the fixed cost and the variable cost, because if you see at output 0 there is still a cost of rupees 5. This indicates that 5 is the fixed cost and the profit is total revenue minus the total cost. So if we see from 0 to 3 levels of unit, profit rises with increase in output. At 4 units of output, there is the maximum TR which is attained there at 40, and the total cost is 31, and the profit remains the same at maximum at 9. So this is the level of producer's equilibrium. If we increase the output to units 5 or 6, profit falls with the increase in the output. Thus, any rational producer will, be producing only at 4 units of output, and that is known as the producer's equilibrium. Now, according to the table, the maximum profit of 9 can be achieved by producing either 3 units or 4 units. But the producer will be in equilibrium at 4 units of output, because at this level both the conditions of producer's equilibrium are being satisfied. That is, the producer is earning a maximum profit of rupees 9 and the total profit falls to rupees 8 after 4 units of output. If we see this in terms of a graph, TR and TC reflected on the y-axis and the quantity or output is reflected on the x-axis. TR is the total revenue curve and TC is the total cost curve. Now, the producer's equilibrium will be determined at the level of OQ output, at which the vertical distance between TR and TC is the greatest. So at this level of output, the tangent to TC curve at point G is parallel to the TR curve, and the difference between both the curves, which is represented by G and H, is the maximum. So this is at quantity Q, that is the level of producer's equilibrium. Discuss the mechanism of investment multiplier with the help of a numerical example. Increase in investment in an economy generates a multiplier effect on its national income. The extent of multiplier effect and therefore the extent of the total increase in income depends on the marginal propensity to consume, that is MPC. Higher the MPC, greater would be the multiplier effect and vice versa. Now let us see the working of multiplier. An additional investment of rupees 100 crores, that is change in investment, is made to construct a flyover. This extra investment will generate an extra income of rupees 100 crores in the first round. But this is not the end of the story. If MPC is assumed to be 0.9, then recipients of this additional income will spend 90% of rupees 100 crores, that is rupees 90 crores as consumption expenditure, and the remaining amount will be saved. It will increase the income by rupees 90 crores in the second round. In the next round, 90% of additional income of rupees 90 crores, that is rupees 81 crores, will be spent on consumption and the remaining amount will be saved. The multiplier process will go on and the consumption expenditure in every round will be 0.9 times of the additional income received from the previous round. Now we have to complete the table where income is given at Y and consumption is given. We have to calculate APS, the average propensity to save, and the MPS, which is marginal propensity to save. Now we know that APS is equal to Y upon S. So calculating this at zero level of income, we don't have any APS. When the income of level is 50, we take 50 divided by saving, which is minus 20. So we get APS of minus 2.5. At 100 level it becomes infinity, and at 150 level of income it is 3. Now MPS is change in saving upon change in income. The change in saving in this case is at 50 level of income is minus 20 minus the earlier one minus 40 upon 50 minus 0, which gives 20 upon 50, which is 0.4. At 100 level it is not applicable. Then at 150 level of income it is 30 minus 0 upon 150 minus 100, which gives 30 upon 50, which is 0.6. Explain any two functions of the Reserve Bank of India. The two main functions of Reserve Bank of India are issue of currency. Central Bank of a country has the exclusive right of issuing notes, or it is the only currency authority. It is the sole agency of note issuing in the country. Actually, till the beginning of 20th century, the central bank was known as the Bank of Issue. The notes issued by the central bank are an unlimited legal tender. The second function of RBI is that it is the lender of the last resort. The central bank acts as the lender of the last resort. When the commercial banks fail to meet their financial requirements from other sources, they can approach the central bank, which provides them with loans and advances as lender of the last resort. The central bank provides this facility to protect the interest of the depositors and to prevent possible failure of the bank. The commercial banks can borrow on the basis of approved securities. Show with the help of a diagram how exchange rate is determined under flexible exchange rate system. The flexible exchange rate system is determined by the interaction of the forces of demand and supply. The equilibrium exchange rate is determined at a level where demand for foreign exchange is equal to the supply of foreign exchange. This will be clear from the given diagram. On the y-axis, we take the rate of foreign exchange, and on the x-axis, we take the quantity of foreign exchange. DD is the demand curve and SS is the supply curve, and they both intersect at point E, which is the equilibrium level, and R is the equilibrium quantity and Q is the equilibrium, R is the equilibrium price and Q is the equilibrium quantity. And as seen in the diagram, demand and supply of foreign exchange are measured on x-axis, whereas rate of foreign exchange on the y-axis. DD is the downward sloping demand curve of foreign exchange, and SS is the upward sloping curve of the foreign exchange. Both the curves intersect at point E, and the equilibrium exchange rate is determined at OR, and the equilibrium quantity is determined at OQ. Beyond the point of R at R2 is what is shown is the supply is more, so we have the case of excess supply, and at the price of R1 there is excess of demand, and this is below the equilibrium point. What is an indirect tax? How it is different from a direct tax? A tax which is levied on goods and services rather than on income or profit is called indirect tax. A direct tax cannot be shifted, whereas indirect tax may be shifted. For example, GST is an indirect tax and can be shifted, whereas income tax is a direct tax and cannot be shifted. Differentiate between revenue deficit and fiscal deficit. Fiscal deficit shows the excess of total expenditure over total receipts excluding borrowing. Therefore, fiscal deficit is equal to total expenditure minus total receipts excluding the borrowing. Revenue deficit shows the excess of revenue expenditure over the revenue receipts. Revenue deficit is equal to revenue expenditure minus the revenue receipts. Fiscal deficit measures the total borrowing requirements of the government. Revenue deficit indicates the inability of the government to meet its regular and recurring expenditure. Fiscal deficit, the source of fiscal deficit is tax and non-tax revenue, but the source of financing of revenue deficit is borrowing and deficit financing. The monetary measures to correct inflationary gap are the cash reserve ratio and the repo rate. The cash reserve ratio is the percentage of bank deposits which are held as reserves with the central bank. The central bank has the right to fix the CRR or the cash reserve ratio. The central bank can reduce the inflationary gap by raising the CRR. Raising CRR will reduce the lending capacity of the commercial bank. Lower lending will lead to fall in aggregate demand, which is helpful in reducing the inflation in the economy. Next is the repo rate. In case of inflation, RBI will try to reduce the amount of money in circulation by increasing the repo rate. When the repo rate is increased, banks will borrow less from RBI, and hence the amount of money they will be lending to the public also decreased. A fall in the money supply means a fall in the aggregate demand. Explain the concept of inflationary gap with the help of a diagram. Discuss two monetary measures to correct it. Inflationary gap is the excess of aggregate demand over and above its level required to maintain full employment equilibrium in the economy. In the diagram, we take the aggregate demand AD on the y-axis and the employment income or output, that is the GDP, on the x-axis. ADF is the demand curve and AD1 is the increase in the aggregate demand over a period of time. And expenditure is denoted by the Y and it is at 45 degrees angle. The increase in the price from E to point F is the inflationary gap, because at this is over and above the level which is required to maintain the full equilibrium level in the economy. Explain the following terms: fiat money, deposit money and token money. Fiat money is the currency notes and coins. These are called as fiat money as it serves as money on the fiat, that is order of the government. Deposit money is the money which is deposited in a bank in saving or current or deposit accounts. Token money refers to notes or coins for which the value written on them is greater than the value of the materials they are made up of. How do commercial banks create credit? Explain with the help of an example. Credit creation is one of the most important functions of a commercial bank. It constitutes the major component of the money supply in the economy. The commercial banks create credit in the form of demand deposits. The process of credit creation occurs when banks accept deposits and provide loans and advances. When the consumer deposits money with the bank, they are called primary deposits. This money will not be withdrawn immediately by them. Hence, banks keep a certain amount of deposits as reserves, which are known as legal reserves ratio, that is the cash reserve ratio and statutory liquidity ratio, and provide the balance amount as loans and advances. Every deposit creates a loan. Commercial banks give loans and advances against some security to the public, but the bank does not give the loan amount directly. It opens an account in the name of the borrower and deposits the amount in that account. Thus, every loan creates a deposit. These deposits created by banks with the help of primary deposits are called derivative deposits. Let us take an example. Suppose primary deposits are rupees 1000. The cash reserve ratio is 10%. Now the banks can lend out rupees 900 only. That is primary deposit minus the cash reserve of 10%. So 10% of 1000 is 100 rupees. So 1000 minus 100, which is 900, is available for lending. Now the bank will give the amount to his creditor only in his account, which is opened in his name. The borrower can deposit the amount with his bank. Then that other bank can lend out 900 minus the 10% of 900, which is 90 rupees, and he can lend out 810 rupees, which has come back to the bank in the second round as primary deposits. This process will continue, and if there is no cash leakage, the credit creation would be processed as given below. The primary deposit is 1000, 900, 810 and so on. The cash reserve ratio initially 100, then 10% of the primary deposit 90 and 81 and so on. The derivative deposits out of this is, in the first case, 1000 minus 100, which is 900, then 900 minus 90, which is 810, then 810 minus 81, which is 729 and so on. This process can be explained with the help of a formula. The total credit creation is equal to primary deposit multiplied by 1 upon cash reserve ratio. So total credit creation is equal to 1000 into 1 into 10% divided by into 1 divided by 10%. So total credit created is equal to 10,000 rupees. Thus, we see that from a primary deposit of 1000, the credit is created to the extent of rupees 10,000. Explain the components of compensation of employees for calculation of national income by income method. Compensation of employees, or COE, refers to the amount paid to the employees by the employer for rendering productive services. It includes three elements, that is wages and salaries in cash. It includes all monetary benefits like wages, salaries, bonus, dearness allowance, commission, etc. It also includes the wages and salaries in kind. It includes all non-monetary benefits like free residence, free car, free medical and educational facilities, etc. The imputed value of these benefits should be included in the national income. The employer's contribution to Social Security scheme is also included under COE. It includes contributions made by the employer for the social security of the employees. For example, contribution to provident funds, gratuity, labor welfare funds, retirement pension, etc. The aim of such contributions is to ensure the safety and security of the life of employees. From the following data, national income is to be calculated by income method and expenditure method. What we are given is compensation of employees, government final consumption expenditure, net factor income from abroad, net exports, profits, net indirect taxes, mixed income of self-employed, rent, interest, private final consumption expenditure, net domestic capital formation and consumption of fixed capital. We first calculate the national income by income method, where we add the compensation of employees plus operating surplus plus mixed income. So under COE, which is given to us, that is 700 rupees 700 in crores. The operating surplus is the total of profits plus interest plus rent. So profit plus interest plus tax is added to COE, and the mixed income is given as 350 crores. When we add all of these, we get the net domestic product at factor cost, which is 2160. Now we add the net factor income from abroad to NNP at factor cost to find out the NNP at factor cost. So NDP at factor cost plus NFIA, which is 2160 plus, which is given as NFIA is given as minus 10, we subtract it, so we get 2150. This is the NNP at factor cost, or what we term as the national income. Now calculating national income by expenditure method, we first find out the GDP at market price by adding private final consumption expenditure, which is 1100, then government final consumption expenditure, which is 750. Then we have the gross domestic capital formation. We are given the net domestic capital formation and consumption of fixed capital. So we add these two amounts, that is 385 plus 65, and we add the net exports. Net exports are given to us at minus 15. So the total GDP at market price comes at 2285. Now to calculate the NNP at factor cost, from the GDP at market price, we subtract the depreciation of or the consumption of fixed capital, which is 65. We add the NFIA, which is minus 10, and we subtract the net indirect taxes, which is given to us at 60. So the total comes to 2150, which is the NNP at factor cost or the national income.